Apple's up more than 6% right now. Google about 3%, but Dell, Intel, Research Motion, and Microsoft are all to the upside. Look how strong.
Did not disappoint. 400 points higher. Yes, indeed. The markets roar higher last 30 minutes of trading as volatility once again rules the day.
Most of the techs this morning, if not all of them, have just exploded to the down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and what a day. A lot of green, not that much red, and green in the places where it mattered. US stocks were very bullish. The S&P 500 closed at a record high on the back of a slew of updates, including solid US economic data, upbeat Micron earnings, as well as China stimulus. And as a result, technology, semis, financials, as well as materials rallied. We saw a strong rally in these sectors and then very 50-50 trade in other sectors. For example, consumer cyclicals, everything excluding Tesla and Amazon was very green, but Amazon and Tesla itself pretty red. Bit of a dumpster fire in the context of today's trade. Apple and Google were very green. Meta was flat on the day after its event, and energy and real estate were the worst performing sectors here today. Both these sectors were down 1% and 2% respectively. Now, energy is more tied to the price of energy, and this entire sector has been in a bit of a dumpster fire. But the materials sector as a whole was up 2.1%. When China does well, materials are going to do very, very well. And that is sort of a play on the China trade. If you don't want to directly hold Chinese stocks, they're going to be complete beneficiaries of it. They're also a hedge against debasement and inflation risk. And with this stimulus, there is risk of that occurring. We also saw technology after Micron's earnings. It sort of lifted the entire semi space, revalidated a few things for the AI runway, maybe even extended it out a bit. And that's sort of what the market was pricing in today. Communication services will always track technology very closely. And then we had quite a number of sectors in the green too. Industrials, financials, discretionary, all up 0.5, 0.5, and 0.4% respectively. And really the worst performing sectors here today were sort of just defensive names. Today was a risk on day, particularly in early morning trade. It was very risk on by cyclicals, by growth, by small caps, which were the outperformers across the spectrum here today. We saw mid caps gain as well, particularly in core and growth, and really mid cap value and large cap value did suffer along with large cap growth. It was really just a day for small caps and then like mid cap growth core and large core. That was really where the majority of today's price action took place. And all of this price action started off with US economic data. Weekly jobless claims fell more than expected, pointing to a steady labor market. Durable goods orders was unchanged, but the forecast was negative 0.3%. We also had a massive July revisions, and I talk about that in the macro portion of the video. And then the final second quarter revision came in at 3%. The forecast here was 3%, so it came in flat. I saw some figures saying 2.9%, but all of this is telling us that the economy is strong, the labor market is strong, and if there is a problem in the economy or the labor market, it's certainly not showing up in this data right here. But when it comes to the labor market, the labor report is obviously going to have a much more defining role in terms of market sentiment. On top of that, China stimulus also lifted the broader market. As China goes, so too does Europe, and that's why Europe was very green. China was very green. Australia too, a heavily based mining economy, materials based economy. We saw the same here in South America. Stuff like the company Vale in Brazil, the largest iron ore manufacturer, they all directly benefit from the China stimulus situation. And then as a result, the US had its own economic data as well as earnings release, and that that saw the US market upbeat, but the US markets actually underperformed the global markets here today. So if you were in tickers like the ACWI, the All Country World Index, you probably outperformed here today. It was best to be in these other names. And I think in the weekend video, so go ahead, subscribe so you don't miss it, I'm going to break down some Chinese shares that even though they have rallied quite a lot, there's still a lot of value to be found in China stocks, and we're going to look at a couple of them on the weekend video. So subscribe so you don't miss a beat. And with China's stimulus, guys, they pulled out the big guns, according to David Tepper. They put out new pledges to lift fiscal spending, halt the property crisis, even support the stock market by increasing shareholder value. I think their authoritarian approach, they're also going to take a step back. The market really like that. And China right now is on track for its best week in a decade. Essentially, where the US was in 2008, that's exactly where China is right now. I think if you look really long term down the track, 5-10 years, I think you're going to be thanking yourself if you're in the right names. You're going to have complete outperformance in the next decade, assuming the stimulus does do the right things to the economy and the economy moves out of this without a massive inflationary bust. And looking at the markets from a glance, everything was really bullish. I mean, yields gained, bonds gained as well, stocks across the spectrum gained, as well as commodities. The only thing that fell today was the US 30-year yield, the DXY, the dollar, and then crude. That was really it. Everything was incredibly bullish today, from the RSP, the equal weight, to mid caps, to small caps, the S&P 500, the Nasdaq 100. But this doesn't show us the actual price action of today, because things were even more so bullish at the start of the day. Look at the S&P 500. Look at this candle, right? We actually gapped up above the previous call resistance. The call resistance did move up, but we gapped up, sold all the way down, and found a bottom right here, and then paired some of those losses on the day. Still up net 0.5%, 0.4% here today. If we actually go on the 1 minute chart and look at the daily price action, you can see this is where we opened. We opened up about 1.5%, had a huge sell down into midday's trade, and then from there paired a lot of those losses. Still net we were up on the day, guys, but really the bears did come in from the highs, and that was the case for all of these indices. Look at the Nasdaq 100 as well as the IWM, where the S&P 500 and Nasdaq 100 actually moved higher into the close. The IWM sort of stayed at its lows for the day, so there's still that rotation into quality. I think still a bit of nervousness into next week's data as well as tomorrow's inflation print, and there's also just a little bit of valuation concerns in the US market right now. Things looking very rich, and that's why we're seeing the price action we see right now. When valuations are really rich, you get like strong data, will sort of like gap up, rally and go, and then pair those gains. Whereas if something isn't as overvalued, when the valuation isn't as rich, will sort of gap up, have a minor pullback, and then just continue higher. That's exactly what we saw with China today. And when you look at a stock like PayPal, it's very easy to see that valuation really does matter in stocks. We sort of gapped up here with PayPal, pulled a little bit back, and then we continued the move higher, and PayPal was actually up 3.5% on the day, up 0.2% here in the pre-market. And that's why you always want to buy great businesses at an attractive price, because when you do get these strong economic data prints, you know, you sort of break out, pull back, higher low, and then you just continue the rally. Whereas in something like the S&P 500, you could see that rally wasn't quite as strong. You never took out the highs of the day, and that is why valuation does matter when it comes to stocks. But looking at the overall S&P 500, things looking very bullish. We're still making higher highs, higher lows, and we did actually make a new all-time closing high in the S&P 500. That's bullish, guys. Insanely bullish. This almost looks like a breakout, but very weird situation with the gamma chart. Everything did move up. So, you know, the core resistance, the gamma flip, and the put support all moved up from lower levels to where they are situated right now. This does mean we probably have a bit of upside to the 5800 here in the S&P 500, but we are seeing volatility compression. Normally when the gamma flip and put support get this close to each other, it can be concerning, because normally if we do like get a pullback, let's say to this level, and then we slice right through, then we're not just in negative gamma, we're in negative gamma below the put support, and things can get very ugly in that type of environment, because then dealers just start selling into the selling, right? They sell into weakness and you can get violent moves. And this was just on the back of the economic data. So what we want to see is either this gamma flip move up to this level right here and the put support actually move lower. If we can get that, that would signal very healthy price action. But if we do pull back and the gamma flip and the put support is this close to each other, we do run the risk of breaking below into negative gamma, and things can get a little bit shady for the S&P 500. And do take it into consideration, guys, we are still in the most volatile month of the year at a volatile period in an election year. So things can get very ugly very quickly despite making all-time highs. And that's why you want to really sit through the volatility, have cash on the sidelines, and be ready to buy the dip. Looking at the RTY, nothing has changed for the RTY in the gamma zones. I still think that if you're waiting for the 2175 area, that's prudent to buy the dip, and then we'll go from there. But as long as we stay above this low in the IWM right here, I think that we're probably going to move higher into the end of the year. This is a very constructive consolidation period that we're seeing right here in the IWM. And then looking at the RSP, not quite an all-time high, but we did wick at an equal high. Very constructive. This looks very strong. And yesterday's dip at this area, we didn't quite get to the 176, 175 area, but it was a great opportunity to move higher. What did the RSP do on the daily chart, on the 1 minute chart? Yeah, very sideways action. It gapped up less than the S&P 500, but traded pretty much flat, slightly up. Most of the move was predicated on the gap up. Yeah, you can see right there. So definitely relative strength in the RSP in the broader index compared to something like the S&P 500. But looking at things in aggregate, we're still in positive gamma, and in positive gamma, guys, you want to buy dips, you want to sell rips, and you want to aim for the 5800. The market is indicating to us that there's a little bit of upside to this level, and if we do get the data we want tomorrow, which I think we're going to get inflation prints, the PCE print that comes in line, the big focus is going to be those personal income outlays. That's where a lot of the market's going to look to. But if we do get the data we want, I think we can see the 5800 area tomorrow, no question, or somewhere around there. But if we do get a bit of a sell-off in tomorrow's trade, the bulls need to hold the 5675 area with conviction. Otherwise, things get very ugly below here. Looking at sentiment, this is the AA sentiment survey. Very interesting results. Guys, we're still in very bullish sentiment. 49.6% of individuals here are bullish, 23.7% are bearish. We saw a downtick in bullish sentiment as well as bearish sentiment, and we just saw more people get into the neutral camp right here in light of the rate cuts we had last week and all of the price action we're seeing. You need bulls for a bull market, and we have incredibly bullish sentiment. And part of the reason why sentiment is bullish has to do with the fact that we're in a cutting cycle. Rate cuts are coming, and the market expects the Fed to cut another 75 basis points this year. Both expect exactly the same through to December, but where they differ is the long run rate. This is the median FOMC projection, and this is what the market is pricing. This is what BOFA expects, this dark blue line, and you can see that the market pricing and BOFA's expectations are far more dovish than what the Fed is expecting. I think the Fed have to err on the side of caution to not get the market hyped up. But this is also a good thing because it does signal to us that the Fed think the economy is in a lot better shape than what the market thinks. But long story short, guys, we are in a cutting cycle, and we should see anywhere from 50 to 75 basis points between now and December. So that would mean a 50 and 25 cut or a 25-25 cut in the next two Fed meetings. Another reason why things are so bullish has to do with earnings. Guys, this is BOFA's earnings right here. They see consensus projecting 18% EPS growth by year end 2025. I think this includes the next 2 quarters, and which is incredibly bullish. When we've been in an earnings recession and we come out of that recession, we normally rip to the upside. That's exactly what we're doing right now when we had our earnings recession in 2023. But 18% growth by year end next year, to me, this is really bullish. I want to see these estimates pull back. Maybe 15, 14% is is more doable, but we are going into a cutting cycle. And if this is what the market expects and these figures materialize, stocks are going to do very well into the end of this year as well as next year. And when you combine strong earnings with favorable Fed policy, stocks tend to perform exceptionally well, especially when we avoid a recession. S&P 500 performance when we don't get a recession is very, very bullish. However, when we do get a recession, things can get a bit dicey. I personally don't think we're going to see a recession. And when you get aggressive rate cuts combined with strong earnings, things are very, very positive. Now, this right here is the EPS trajectory for next year and into 2026. And you can see past rallies right here have been accompanied by almost no earnings growth, which stands in stark contrast to the present setup where earnings growth looks very, very strong, at least the consensus estimates. Currently, the consensus expects 12% EPS growth over the next 12 months, 18% through to the end of 2025, and 24% over the next 24 months for the S&P 500. And the S&P 500 equal weight is roughly the same. So guys, just think of the returns on this if the current earnings picture does materialize into this. Very, very constructive. Going into rate cuts, going into easier policy, going into a higher liquidity environment, I think stocks are going to do very, very well. However, valuations may drag on stocks in the near term, especially considering where we are standing right now. The S&P 500 looks rich, very, very rich, trading at 21.6 times earnings on a PEG of 1.3 and a free cash flow yield of 3%. Very unattractive figures if you ask me. To find value outside of the S&P 500, you're gonna have to look down the sector spectrum. You're gonna have to look at stuff like energy, financials, utilities, and real estate, at least on a PE basis. On a price to earnings basis, you're gonna have to look at healthcare and comm services. That's where you can find value in growth. However, the equal weight doesn't trade on such a rich valuation. In fact, the equal weight trades at about 18 times. If you are looking for value, either look at these sectors or just buy the equal weight over the S&P 500, and you should get outperformance over the next 12, 18, and 24 months from that. But where else can you find value outside of the US? And I think one place you can look to is China. China unveiled a ton of new stimulus over the last couple of days, and there's more incoming. We got some headlines that they're considering a $145 billion liquidity boost to banks. Their latest stimulus sees a ton of monetary policy interventions, cutting rates by 20, 30, and 50 basis points across various products. For the property market, they're looking at cutting the down payment for second home buyers. They're raising the lending quota, cutting interest rate for existing mortgages by 50 basis points. That's big. They're allowing banks to support land reserve buybacks and extending operating loan issuance rules and 16 measures. So essentially, those people that are hurting, they're just going to extend their loans out so they don't have to go bankrupt or reorganize in the current environment. For the equity markets, what we're really interested in, we saw a $500 billion liquidity provision program for non-bank financial institutions to borrow money directly from the PBOC and qualified collateral. Essentially, if you need money to pay a margin, we got you. We have this lending facility. $300 billion lending program for banks to support listed company share buybacks, improve listed company quality, attract long-term capital investors to the market, promote high-quality development and serving the real economy, promote mergers, acquisitions, and reorganization activities, focus on investor protection and shareholder returns. So very shareholder-friendly stuff right here, very bank-friendly and corporate and company-friendly policies that China is implementing to stimulate the economy. They're not just pumping a whole bunch of money into the market, they're pumping a whole bunch of money into the market and also making the market much more shareholder friendly. And generally speaking, when we have a large stimulus with policy regime changes and sentiment is in panic mode, stocks, especially China equities, tend to do very, very well. This is forward returns for the MSCI China Index when the China Risk Love Index hits panic. It's currently in the panic zone, and generally speaking, 12 months later, we can see very stellar returns, 24% average, 22% median return, 79% of the time higher, 15 months later, 34% on average, 18 months later, 35%. So some very robust returns over the next 12 months. months. So if you want to diversify your portfolio internationally, I think a great place to look at, especially if you're looking at longer term, place you can look at is China, although manage risk accordingly. Enough about China. Let's talk about the macro, specifically US macro. And before we get into the technical details, this was a very interesting graphic. 58% of Americans expect the November election will positively impact the US economy. I think regardless of which side you're looking at, Americans are saying, hey, we could potentially see tax cuts across the board from both parties, and Americans like that. More than 3 in 5 Americans are deferring financial decisions until after the election. We see that both in the equity markets as well. Generally, people don't want to put capital to work when there's uncertainty. Once we know who the president is going to be, markets tend to rally. Nearly 4 in 5 Americans expect their personal finances will deteriorate should their preferred candidate fail to win the presidency. Very interesting. Inflation is at the top of Americans' mind when choosing their preferred political candidate, obviously, and 1 in 8 Americans have partnered with a financial planner specifically to guide them on the impact of the current political environment. Now, we got a number of data prints before the open, which really supported price action today, especially in the early morning trade. One of those was the second quarter GDP revisions that came in at 3%, meaning the official quarterly GDP figure is 3%. The market was expecting 2.9% and it's actually in line with the first revision. So 3% for this quarter. And this marks, guys, 8 quarters of just solid economic expansion. The economy is on a roll at the moment in the growth department as well as the labor market. Initial jobless claims came in better than expected. That's about 8 or 9 weeks in a row of very solid initial claims. The market was expecting 225, 218,000 was reported, and this signals to us a tight labor market that's at or near full employment. Very solid data. And probably the most surprising data was the durable goods data. Durables came in at 0%, so there was virtually no growth month over month, but the expectation was actually to see a decline of 2.6%, so this was a solid beat. But the big question was actually the July revisions. We saw the July durable goods now officially printing 9.9%, where previously they printed negative 6%, so a huge revision to the upside. We know durables has been in a recession for the better part of a year, so to see this figure right here is probably signaling a takeoff from the bottom, and we should see that recovery in durables, which should support economic growth into 2025. If we can see the housing market, durables and autos come out of the recession they've been in for the last 12-18 months, that is going to drive growth into 2025. So very solid data across the board. This screams soft landing, no recession to me, and you want to hold equities, especially going into rate cuts. I say it every video and I will keep saying it, guys. The economy is strong, no recession, soft landing is on the table. Stocks do well in that type of environment. And diving into data, so tomorrow on the 27th, guys, we have wholesale inventories, the goods trade balance, and then the big one's going to be the PCE, the headline and core figures, and then the income outlays, the personal savings rate and personal spending rate. Now, these are going to be the 2 big ones. The personal spending, both for consensus, is to come in at 0.2, the consensus is 0.3, and the personal savings rate, BOFA's estimate is 3.2%. Headline month over month 0.1, headline year over year to come in at 2.2%. That's BOFA's estimate. A little bit more hawkish on the consensus estimates. And then looking at core, 0.1% is BOFA's estimate, 0.2% is the consensus, and then 2.7% for each BOFA's estimate and the consensus. So BOFA are slightly more dovish. They see continued disinflation greater than the consensus expectation right here. But all in all, we should see inflation continue to move on trend. Even if we get a hotter figure, I don't think it's going to derail the market. I think what the market's really going to be looking at tomorrow is the savings rate and personal spending, because that goes directly to the employment picture. So if these figures miss, that's when things are going to get really ugly. And then we also get University of Michigan sentiment. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.